The markets have rallied massively from the news that Pfizer are bringing out a vaccine, and I'm getting into a super high dividend yielding REIT ETF. But what is it? Hi guys, welcome back, and today I'm a little bit late to the game actually. I'm going to be getting into a new ETF that I've been looking into, and I'm probably doing it at almost exactly the wrong time now that the market has rallied because Pfizer has broken news of this new vaccine, which is very frustrating, but is what it is. And in true dollar cost averaging fashion, I'm not going to wait for another dip. I'm just going to get the money in and get it to work. So I'm going to go through what this ETF is that I'm getting into, give you a rundown of what they're about, why I'm getting into it at the moment, where I see that sector of the ETF, certainly the REIT sector, in the coming years, especially with the news coming out of this vaccine. And I imagine things, although it's going to take a while, are going to start getting maybe back to normal. So we're going to get onto the computer and have a look at the ETF itself. I'm going to give you the breakdown of the dividends that they offer, the frequency of the dividends, and we're going to have a look at the website as well, how many holdings that ETF in particular holds. I'm also going to give you a little rundown of one of the metrics you can look at in order to value a company or a fund, closed exchange fund, companies even. One metric you can use is what's known as NAV, net asset value. So I'll go through the calculation of how you do it right there, and hopefully this will start to make a bit of sense. But this is good for valuing any kind of ETF, whether it's Vanguard, whether it's iShares, whether it's ARK, or one of the ETFs that I'm getting into today. What you essentially do is you would take the net assets that the company owns, you would then divide that by the net liabilities to give you what essentially would be left over if the whole fund was broken down completely and they had to just liquidate everything, and they'd sell all their assets for X amount of money, that then pay off their liabilities with that money, and then whatever's left essentially is what the company is worth. So at that point you'd take that resulting value, whatever that might be, and you then divide that by the number of shares issued. Let's go through it as a really easy example, and again I'll put it up there on the screen. So if you have a company that has got $100,000 worth of assets once all sold and liquidated, and they only had $20,000 worth of liabilities, you take your 20,000 from that, you're left with 80,000. That essentially, once everything's broken down and brought back to its bare bones, that's what the company's worth. That's how you'd calculate your net worth anyway. Let's say you had a mortgage of X amount and loans of X amount, but your house was worth this, car loan was worth this. You take all those values, take away your loans and your mortgages, which is your liabilities, and that's your net value. That's what you're worth, your net worth at the end of it all. So you'd be on £80,000 net worth, and then the number of shares issued, essentially public ETFs like this are owned by the public. They are broken down into shares of the company in which people purchase. So essentially you would take your $80,000 or pounds, and say the company had 100,000 shares issued, you divide that by 100,000. Each share would therefore be worth 80 cents. That's 80 cents per share. So you'd look at that as the NAV. Now, if the share was trading at a dollar on the market, and the market was valuing the share at $1 a share, you would look at that and think, well, actually, that's overvalued by 25%. And I don't want to be getting into it at that point, because if you break everything down to its bare bones, that share at $1 is overvalued by 25%. If the share was actually trading at 60 cents, you look at it and think, well, the market's undervalued this, and actually that's looking like very good value for money at the moment. So the ETFs that we generally look at, and I looked at quite a few, I looked at a lot of the Vanguard ETFs, the high dividend yielding Vanguard ETF, the total stock market, VOO, which is just the S&P 500, and a lot of them were coming out, certainly at the moment with the rise in the stock market we've just had, they were coming out a little bit expensive. The ETF we're going to look at today is also coming out a little bit expensive based on this NAV valuation, but this is more of an income fund, I guess, and I'm looking at it more because it's quite high yielding as a income rather than a growth ETF. If it grows, great, and I think it probably will based on where we are right now, and I'll show you that on the computer in a second. But it's going to be a growth ETF, income ETF more than anything else, and I'm looking for that kind of monthly, quarterly income coming in. So I'm not too bothered about slight disparities in the NAV. It's certainly not too far. They're not too far apart. The market value and what the NAV net asset value is coming out at, that's close enough for me not to really worry too much about it. It's not overpriced a great deal, and we've had a bit of a rise in the market more recently. It's something that I'm still very happy getting into. So we'll jump into the computer and we'll have a look at the company itself, and we'll have a look at the ETF that I'm going to be getting into. All right, here we go in the portfolio, and the keen-eyed viewers amongst you will have seen what the company certainly is and the ETF is already. I'll run through the direction I'm wanting to take the portfolio in now. So I'm just going to quickly get the history up of what I've been in and out of, out of more recently. So let's go past activity, last 3 days. So these two companies, Wex Inc. and Uber, I have sold out of completely in the last 3 days. And the reason for that is they don't pay a dividend. Uber I got into absolutely ages ago. They are now, or were, they absolutely skyrocketed to, I can't even remember the percentage, but effectively from when I got into it, I was about 172% up in Uber, and Wex was nowhere near that. It was maybe 25-30% up, but enough for me just to start getting out of those positions and start being able to reallocate the capital into dividend paying stocks for my income portfolio. So I'll go straight into it. So here it is, ticker symbol SRET, Super Dividend REIT ETF, and it is by Global X. Global X is the company that is running the fund. I'll go through a couple of just primary things. The main sort of exchange for all the companies in this is the NASDAQ, and they are holding 30 companies currently. They're all REITs, as you are probably aware and can see. So REIT is a real estate investment trust. So they invest your money into real estate for you without you having to come up with the capital initially and manage things and bits and pieces like that. So good safe way of getting into a bit of property maybe, and a bit of exposure in property. Fund is primarily situated in the US, as in the companies are primarily situated in the US, and these are the top 10 holdings. So actually, Annaly Capital I invest in anyway. Blackstone is a well-known name for REITs as well, but these are the top 10 holdings in the REIT ETF. So let's have a look at a couple of bits on Seeking Alpha. As you all know, my preferred go-to website for looking at companies and stocks and shares. So we've got an 8.42% dividend yield, which is a monster, and they pay out monthly, which is lovely to be receiving those dividends on a monthly basis and reinvesting those back into the portfolio. So I've got nearly £1,740, which would be what, $2,000, just over $2,000, ready to invest. I'm not going all in with this ETF. I'm going to allocate the vast majority of that to this ETF, and actually it's all live now. So let's do that. SRET. This time I haven't looked at how many I need. So let's look. I mean, as I showed you before, we're way up when I could have been buying it down below the $8 mark only a few days ago. But the fact is, they're way lower than where they were, and I think REITs are going to start performing a bit better now that we've got a bit of news on a vaccine and things are going to start to get back to normal. Not straight away. Going to be probably a couple of years yet until we see those highs like up here, but certainly looking that way. So let's go into buy. I have no idea how many I want. Buy at $8.49. 200 shares comes out at 1,287, and I think at the moment that's a nice round figure, so we'll leave it there because I want to put a bit more into another ETF as well. So if I do confirm order buy, that's now done. I've now got 200 shares involved in Global X Super Dividend REIT ETF. Now, £452 left. So let's go back into my portfolio quickly here. So as I alluded to in one of my last videos, I feel it's really important just to constantly dollar cost average no matter where you are in the portfolio, no matter what's doing well, what's not doing well. And my favorite go-tos are actually the Vanguards. Now I've got the Vanguard REIT ETF, but what I'm actually going to look at, I think it's VYM, the Vanguard High Dividend Yield ETF. And more importantly, I'm going to look at the Vanguard International High Dividend Yield ETF. This is an ETF that is not just based in the US and US companies, it's international, and the dividend yield a little bit better. It's VYMI. So if we get that up, we've got a 3.5% dividend yield, and I'm going to start building my position up in this amongst others as well, ETFs, and just dollar cost average all the time as much as I possibly can. So I'm going to get at least £90 worth in this. So you'd be £90 or dollars. So two positions in that. Buy that there and then 365 left. So I'm going to come out of this and I'm going to go into my old favorite VOO. And actually that spiked and then dropped a little bit. So I'm going to be able to get at least, I'm going to be able to get one share in that. So again, dollar cost average, just keep buying. Doesn't matter how much it is. That's $325 worth, which is 246, 250 pounds worth. And just keep buying, buying, buying. So I've got 120 left to do. I'm just going to leave that in there because I'm going to keep building up the dividends throughout the month. At the moment, for the month, I'm at £65 in dividends, which will be about $80, $90. And so I'm just going to keep sitting on that, letting that grow, build up to maybe 150, and then I can reinvest a little bit more later on in the month once those dividends have come in. So that's what I wanted to run you through today in here while the market was still open, the US market was still open, give you the direction that I'm taking the portfolio really in terms of coming out of non-dividend paying stocks and going into high dividend paying stocks. Portfolio is getting up to, certainly with the boost we've had more recently, 46,800, which in the US would be probably about £60,000 or so, $60,000, sorry. Just wanted to show you the direction that I'm taking the portfolio. Buy it live, put a lovely, attractive, attention-grabbing thumbnail on the video to get you in to have a look at this, and that's it for in here. So I'll chuck you back out there. Alright guys, I hope that was helpful in some way, shape or form. Just a little bit of transparency as to what I'm putting my money into and starting to steer towards more income ETFs maybe, as there's a bit of safety, a margin of safety in ETFs over anything else, and the income coming in is pretty good. So I think I'm going to be getting into a lot more probably high income, high yielding income funds or ETFs, and a little breakdown obviously what I've gotten out of as well. So just an update on the portfolio to a degree as well, and hopefully you've gotten some sort of value from the video and you've enjoyed watching it. And if you're lasted this long, I'm sure you probably are very bored of me already, but have obviously gotten some value from it to some extent. The channel now is starting to grow somewhat, so that's really down to you guys. I appreciate that. Please subscribe to the channel if you haven't already, because there'll be plenty more content like this. And if you've made it this far and you're enjoying this, then no doubt you're liking the content and you would like to see more, I'm sure. Give the video a thumbs up as always, as it helps the channel. Pop down in the comments what you're getting into, what you're getting out of, what you're selling, where your portfolio is headed. Mine obviously now is headed more income orientated rather than growth. And I'm getting over those speculative plays that I positioned myself in the dip in March and April. I'm starting to get out of those and reinvest the money back into some high yielding dividend stocks for that income. So that's the path that my portfolio is taking at the moment. I'd love to hear from you guys as to what you're doing with yours and what you're getting out of, and whether you think this particular ETF is a good way to go. Let us know in the comments, we'll have a conversation about it. That's it for today guys, so I'll catch you guys in the next video. See you later.